So how can I use a life insurance policy to pay for my child's college tuition? This is a great question for all parents to consider as we are all thinking about our child's well-being and future. So let's use myself as an example for a moment. Say my son is 1 year old, which he is. He's 1 year old. So in 17 years, when he's 18, I'm anticipating that he would want to go to college. And let's say, for example, the college tuition is $50,000 total. So you may be thinking of less than that or more than that, but let's just use 50,000 for round number's sake. So I have 17 years in order to save up $50,000 to pay for his college tuition. What is the quickest and most efficient way that I can do so? Well, there are many different means on how to do so. However, let's consider a cash value life insurance policy for right now. Say that I open up a policy on my son. So my son would be the insured and I would be the owner of his policy. As the owner, I have responsibilities to pay for his base premium or the insurance expense every year. However, I also have the ability to add money into his savings component. Remember, every time that you put $1 into your savings component using a PUA rider, that $1 does two things for you. One, it buys additional death benefit, but two, that money earns a guaranteed rate and dividends. So I could stop paying after 7 years, after 10 years, and I can just wait until he reaches the age of 18 when I need access to the money. So let's just say, for example, I paid into this policy for 10 years only. So he's 11 years old when I stop paying into his policy. He now reaches the age of 18. Throughout those years, those dollars that I have contributed into his policy results in a cash value of $100,000. So I have access to that money. However, I need only $50,000 of that. So what can I do? I can take $50,000 out as a loan. I can use that $50,000 to pay for his college tuition. So what is happening here? The $50,000 that is still left in the policy is earning a guaranteed rate and dividends. The $50,000 that I have pulled out and have used for his college tuition is still doing something for me. That money is still earning me a guaranteed rate and dividends, so that when I pay that money back into his policy, all values are completely restored as if I had never touched it in the first place. It's almost as if that $50,000 had been sitting in there the entire time. We do have to consider how an insurance company charges loan interest on loaned out dollars. However, since we're still getting something on loaned out dollars, it often matches the loan rate, which creates a washout effect. So I'm doing a couple of things there. I'm putting money into this component that's earning me guaranteed rate and dividends. It's buying me additional death benefit, which will benefit the family as a whole. It also allows me to have access to money, very liquid, that I can use for him and for his education. You may think of this strategy as a great way to reach those financial goals for yourself and for your family. However, it is important to consider proper policy design and structure. This is something that we can help you out with. Hit the link below, download a free PDF on how to build your own infinite wealth engine using the infinite banking concept. Also visit us on the web at infinitewealthengine.com and speak to a friendly life insurance agent too that we work with. Looking forward to talking with you real soon. Brandon here saying stay healthy, stay wealthy. Remember to like, comment, and subscribe. Have a great day.